Hello, welcome to 3D Asset Management's first quarter 2018 market commentary and updated market outlook. I'm Benjamin Levine, Chief Investment Officer for 3D Asset Management. Welcome. For some disclosures. So first, the conclusions. Risk regime pivots to higher risk. Risk premiums should be repriced accordingly. That was the message that we got in the first quarter. All things seem to start off well. At the beginning of the year, investor euphoria drove strong equity performance in the month of January, following the passage of Republican tax legislation that lowered corporate taxes to be more competitive with the rest of the world. Capital expenditure surveys, tracked by the Philadelphia and Richmond Federal Reserve offices, reveal cycle-high intentions to increase capital spending by U.S. companies. Then, the January employment release showed an uptick in wage inflation, and bedlam was unleashed, with the S&P 500 index dropping 10% from its year-to-date highs in early February before recovering. U.S. fixed income suffered as the 10-year Treasury rose as high as 2.95% from 2.4% at the beginning of the year before settling down at 2.75% at the end of the quarter. Reflation has now crept into fixed income pricing as investors are now pricing in 2+% inflation based on the difference between U.S. Treasury inflation-protected securities, or TIPS, versus nominal treasuries. Recall in our year-end 2017 commentary, we were cautious on fixed income risks, notably duration or interest rate sensitivity. We expected rate volatility to remain subdued, but also warned that fixed income investors could be spooked by an outbreak in inflation, which could lead to a panic sell-off in longer-term bonds, and we got a taste of that throughout the quarter. At the end of January, we argued that investors had front-loaded about half their annual performance with the strong January performance. That assumed no change to the underlying risk regime, which abruptly shifted following the January employment release at month end. And the risk regime all of a sudden changed versus what investors had gotten used to in 2017. February saw a major unwind of the so-called short volatility trade following the January employment release. Investors betting on tight risk premium pricing and the continuance of low volatility were caught off guard. Those shorting the S&P 500 VIX via exchange-traded portfolios lost most of their investment. In addition, trend-following strategies such as those employed by commodity trading advisors, or CTAs, as well as risk parity strategies, many of which bet on the negative correlation between equities and fixed income, got caught flat-footed during the sell-off and had to readjust their positions accordingly, which fueled even more selling. Despite the turmoil experienced throughout the quarter, the macro backdrop still remains healthy, with global manufacturing and business sentiment still indicating a growth environment. Oil prices have firmed around the $60 barrel range, and credit spreads remain narrow, although they did widen as a result of a rise in key short-term funding benchmarks. More on that later. If one were to assume inflation does not break out in an uncontrollable manner, recall that the new normal demographics of aging demographics, high debt levels, and excess global capacity can keep a lid on inflation, then high interest rates would eventually be a recipe for lower interest rates, as higher rates would ultimately lead to a restrictive macroeconomic environment that would beget lower rates and an inverted curve if the Fed were too aggressive on rate hikes. Regardless of the outlook, investors should appreciate that market risk premiums are going up. That means implied volatility priced into equity options like the VIX should trade at higher levels. Forward equity valuations should come down and credit spreads should widen from their historically high/low levels. And a combination of higher credit spreads on top of elevated interest rates should further drive up the equity risk premium. So the macro backdrop still looks positive, but our expectations for capital asset pricing and pricing of risk premiums should be reset to reflect the new environment. That new environment was partly introduced by a shift in policy regimes from the Fed. In our first quarter market commentary, we used the theme Mission Accomplished, updated March 2018. In his first testimony as Federal Reserve Chairperson before the House Financial Services Committee, newly appointed Federal Reserve Chairperson Jerome Powell gave a personal upbeat outlook on the economy, which Fed watchers interpreted as having a more hawkish bent, causing Fed funds futures to price in a higher probability of 4 rate hikes this year rather than 3. As is typical with Fed congressional testimonies, Powell gave the obligatory defense of the Fed's 2% inflation target, which is a framework that is working, and that the markets understand it. The Wall Street Journal article that linked to this testimony goes on to repeat the familiar refrain of 2% inflation bromides, including 1. It's a sign of healthy demand in the economy, and 2. By pushing up nominal borrowing costs, higher inflation helps give central bankers room to lower rates in response to a cyclical downturn. 2% inflation is what enabled world central banks to maintain emergency monetary policies of zero interest rates and quantitative easing as the world was recovering from the deflationary forces stemming from the 2008 Great Recession. As we move past the 9-year anniversary of this current bull market, we've come to realize that this 2% inflation target has been serving as the markets and the Fed's MacGuffin. A MacGuffin serves as a plot device that helps the story move along or a reason for story characters to move from point A to point B. It serves no other purpose. The Maltese Falcon and the mysterious suitcase in Pulp Fiction are 2 examples of a MacGuffin. 2% inflation is the plot device that has enabled the Fed to embark upon emergency monetary measures during the intervening periods following 2008 and is now enabling the Fed to adopt a more hawkish stance in the current environment. And as new Fed Chairperson Jerome Powell has assumed the average Hitchcock mantle to continue to push this 2% inflation MacGuffin, we can see that the Fed is using this as a way to be able to pursue other policy objectives. Labeling 2% inflation target as a MacGuffin is a bold statement since it implies the inflation target is irrelevant to the Fed's narrative underpinning its current policy stance. Excess valuations on risky assets and the twin deficits of negative trade and fiscal balances, rather than the 2% inflation MacGuffin, seem to be motivating short-term Fed rate policy setting. Several Fed officials, as well as notable economists, believe that the Republican tax plan, combined with high fiscal deficit spending, are providing a sugar high to the economy, especially given the length of the current business cycle. The Fed and some Keynesians would seem to be motivated by a view that fiscal stimulus at this late stage is imprudent and must be counterbalanced by tighter monetary policy. This brings us to the theme of this quarter's market commentary, the mission accomplished. Since the UK Brexit vote at the end of June 2016, we've published several Fed pieces tied around mission accomplished, or the desire by the Fed to normalize monetary policy from the emergency measures that have been in place since the financial crisis, such as quantitative easing and suppressing interest rates. In those pieces written after the UK Brexit vote, we've argued that the Federal Reserve has sought to normalize monetary policy from the emergency measures that were implemented following the 2008 recession. However, as with other strategists calling for a cyclical reflation, we believe that inflationary forces would emerge in the form of higher wages. This has yet to transpire, except for that notable uptick in wages contained in the January U.S. employment release, which caused interest rates to spike and drove a short-term meltdown in volatility trades. Given that inflationary forces do not seem to be gathering steam despite the threat of a global trade war, we pivoted on our mission accomplished thesis to suggest that the Fed's real aim is to tighten financial conditions, whether to offset hyper-stimulative fiscal policy from tax cuts and federal spending, or, as we've come to appreciate, the removal of the Fed put, which started as the Greenspan put during Alan Greenspan's tenure as Fed chair in the 1990s and early 2000 period. There's been no explicit policy stance taken by the Fed in reference to said put, but it can be implied based on the Fed signal following the March meeting that resulted in a quarter-point rate hike that the Fed could, quote, pick up the pace of interest rate increases, end quote. In other words, the Fed appears to be willing to raise rates above their theoretical neutral rate, for example, the level that is high enough to support sustainable economic growth without sparking inflation, in order to preempt any excessive growth down the road. Fed funds futures had been priced in a low probability of 4 rate hikes this year, but this changed in February as the probability for a 2.25% to 2.5% Fed rate rose to a not insignificant level. Removal of the Fed put means that the Fed won't necessarily step in to soothe volatile markets unless that volatility reflects a real systemic threat facing the U.S. economy. The low levels of volatility that investors had gotten used to in 2017, before those who were short volatility via inverse VIX futures exchange-traded portfolios got wiped out, are a thing of the past under this new risk regime of fiscal uncertainty, widening fiscal and trade deficits, and a Federal Reserve bent on normalizing monetary policy, including the withdrawal of implied support when markets turn volatile. So mission accomplished has evolved from normalizing short-term interest rates to normalizing the Fed's reaction function when it comes to implied market support. Whether the Fed reaches mission accomplished nirvana before a global recession arrives remains to be seen, but success could take the form of capital market valuations coming in to reflect the removal of the Fed put without crashing and putting economic growth at risk. A tight wire act indeed, but one that the Fed is willing to walk in order to accomplish its mission. As the Fed has effectively raised the bar for when it chooses to intervene, whether with explicit or implicit support, investors should appreciate that market risk premiums are going up. In the chart here that we display, the forward price earnings multiple of the S&P 500 has come off from its elevated levels seen at the end of the year. Prior to the April 2nd sell-off, the forward equity multiple of the S&P 500 had dropped to 16 times next 12 months expected earnings at quarter end. The forward multiple peaked in mid-January at 18.5 times. The good news is that much of the repricing equity risk had already occurred throughout the first quarter, and even with the markets down on the first trading day of the second quarter, the risk premium adjustments are starting to take place, allowing for more attractive entry points for risk-seeking investors, assuming the macro environment holds up. Although underappreciated today, the macro environment from 2012 to 2015 didn't look as attractive, and that resulted in investors rotating into low volatility defensive segments of the market. One could argue that the macro environment looks more attractive today versus the earlier period, barring a systemic blowup out of China. Here we show two indicators of financial conditions, the Bloomberg Financial Conditions Index and St. Louis Financial Stress Index. Both have certainly tightened as a result of higher interest rates, although they have tightened from very loose levels. This is the intent of Fed rate hikes, to tap the brakes on marginal lending, but not so much that it causes a screeching halt to the economy. Again, this is one sign that the risk regime is starting to shift. It's shifting from very loose financial conditions and low volatility to one that reflects perhaps a more normal environment. Inflation risk is elevated, but not a serious concern, as indicated by the 5-year forward inflation expectations priced between TIPS and nominal treasuries, as well as a flattening of the 2 to 10-year U.S. Treasury term structure. These suggest that fixed income investors are not expecting an upsurge in long-term inflation and imply that there is a lid to Federal Reserve rate hikes. If the markets were concerned about the economy sliding into a deflationary recession, then we would likely see those concerns being priced into long-term inflation expectations dropping well below 2% and the term structure inverting with short-term rates exceeding long-term rates. Corporate borrowing has also gotten more expensive. Here we show the spread of BBB rated corporate borrowers expected to pay above risk-free treasuries. On the corporate lending side, financial conditions have gotten noticeably tighter as many investors have raised concerns over the widening spread between short-term LIBOR rates versus overnight lending. Widening spreads could indicate heightened demand for U.S. dollar liquidity by banks. However, some market observers believe a doubling of the LIBOR overnight spread from 2009 levels could reflect the new normal of lower corporate demand to park overseas cash into short-term credit as a result of the Republican tax plan. Even if a widening LIBOR overnight spread can be explained by this new demand dynamic, as opposed to a sudden need for liquid U.S. funding from banks, it still reflects tightening conditions that have spread to the broader investment-grade market. Global business, though, still looks robust. Have the global macro conditions peaked? Will the currency cycle be upended with a trade war? Despite central bank tightening and U.S. dollar weakness, the macro outlook overseas still looks robust. Here we revisit the long-term systemic risk China's debt balance poses to the rest of the world. This ultimately gets resolved through a major currency devaluation, but as a risk with a long fuse. We bring this up because we wanted to highlight something that was written by Grant's Interest Rate Observer. And this is highlighting the risk posed by the large presence of Chinese commercial banks, as indicated by the percentage of commercial bank assets of world GDP. Using data from Bloomberg, we recreated the chart from Grant's displaying total Chinese commercial bank assets as a percent of world GDP compared with the US and Japan, all in US dollar terms. At nearly 50% of world GDP, the Chinese banking system, estimated at 38 to 40 trillion at year-end compared to 17.4 trillion for the US, is much more highly geared towards world economic growth versus the other major industrialized countries, and certainly geared towards the health of the Chinese economy, which is estimated at 13.1 trillion GDP. Much of China's incremental economic growth comes from credit creation through its banking system. So 15% credit growth off of a $40 trillion asset base would amount to $6 trillion. Even if we were to assume that world economic growth does not falter in the near future, how does one effectively deploy $6 trillion of new credit, and what happens if even 10% of this new credit growth tries to make its way out of the country? Keep in mind that China's trade surplus was estimated at $420 billion at year-end. Apart from widening its trade surplus, difficult in a period of a heightened trade war rhetoric, how would the People's Bank of China even raise the necessary reserves to support this incremental credit growth? So keeping all that in mind, we'd like to highlight what we believe are the key short-term risks for 2018. In our January 2018 market commentary, following the strong 6% return in global equity markets, we suggested that investors had effectively clipped half their coupon in the form of how much total return they could expect via earnings growth. But this was written in the context of no change in the risk regime. Now we're seeing a change to that risk regime. Investors can expect more volatility and perhaps higher risk premiums. For those with a long-term time horizon, higher risk premiums will help establish better long-term entry points to achieve higher expected returns. But investors used to a 2017 risk environment may need to recalibrate their expectations. Now we're going to highlight some performance of key capital market asset class returns throughout the quarter. The ex-US, led by emerging markets, did outperform the US, although EFA was slightly behind the S&P 500. A lot of the outperformance, though, came from the weak dollar. The US dollar was down roughly 10.3% on a year-over-year basis, ending the first quarter. Fixed income investors are earning their coupon this year, but as they saw, they're also facing some rate volatility. The Barclays aggregate is down 1.5% after recovering a bit in the month of March. High yield is down because of spread widening. Non-U.S. Fixed income is outperforming, but most of that is because of the weak dollar. REITs sold off following the interest rate spike, and commodities are actually holding up, but this is mainly driven by oil prices. Despite some volatility that we saw towards the end of the quarter, large cap growth continues to outperform all major styles within the U.S. It outperformed for the quarter, although some of this outperformance narrowed towards the end of March. However, small cap did outperform the U.S. Large cap after having lagged for much of the quarter. Small cap is seen to be a beneficiary of heightened trade war rhetoric versus large cap, which tends to have more overseas exposure. The outperformance in large growth continues to be concentrated in technology and to a lesser extent consumer discretionary, though much of this is driven by Amazon. Technology and consumer discretionaries were the only positive sector performers for the quarter, but they gave back some of their gains in March. Financials held up for the quarter, but then gave back their gains over concerns on rising funding costs, such as the LIBOR overnight spread that we mentioned earlier, as well as a flattening U.S. Treasury yield curve that makes long-term lending less attractive versus short-term borrowing. Tech's dominance is also captured in momentum factor, which continues to be the strongest performing factor among the major factors. Momentum style of investing has led all other factors, but sectors and asset classes sensitive to interest rate changes experienced losses in January, and that was quite a bit of ground that was hard to make up throughout the rest of the quarter. Investors expressed a clear preference for U.S. large cap growth, as both small cap and value lagged throughout most of the quarter, although they made up some ground towards the end of the quarter. International markets turned in mixed returns, with emerging markets in Japan leading all major regions, while broader Asia and Europe lagged. Investors are growing increasingly nervous about Japan Prime Minister Shinzo Abe's alleged involvement in a scandal over the sale of public land to a private school closely connected to the Abe family. Should Abe be forced to resign over the scandal, a leadership crisis could ensue, possibly derailing the economic improvement under Abenomics. It's a slightly positive year for equity alternatives, primarily precious metals and commodities. You can see that REITs took a big hit in the first part of the quarter and made up a little bit of ground following that, but they still remain down for the year. Oil prices are stabilizing around the $60 barrel range, and despite concerns that shale production is going to start picking up and the world markets might be overwhelmed again with a lot of supply coming in, because $60 is seen to be very profitable for many producers, the supply-demand picture dynamic still looks attractive for those bullish on oil prices. You can see at the bottom right that the net differential between supply and demand is now on the demand side for the last several months. Global demand for oil continues to grow. Supply does fluctuate around the price, but you can see here that demand right now is slightly outpacing growth over the more recent period. Industrial metals have weakened while oil remains strong. This is kind of a puzzling dynamic. Some of this is being driven out of some incremental weakness from China, but you can see here that many industrial metals, such as copper, iron ore, and so forth, have been dropping over the quarter, all the while in the face of a stronger oil price. So this just could be some noise, but if we see further weakness in industrial metals, it could signal that the global economic growth story is about to falter. Credit spreads have widened, but off their low levels. Some of this, as I said, it was attributed to the rising LIBOR overnight spread, which spilled over into corporate bond pricing. The macro backdrop for U.S. corporate America looks positive, especially in light of the Republican tax plan, which should be supportive for both equity and fixed income pricing. But again, we're operating off very low levels in credit spreads, and so we're starting to see that normalize a bit, and that should actually be attractive for risk-seeking investors that want to gain incremental risk premiums within the fixed income market. So that wraps up our first quarter 2018 market commentary. Again, thank you for joining us. If you have any questions, please feel free to contact us. We can get in a little bit more detail about what happened in the quarter. As on an administrative note as well, keep a lookout for our first quarter portfolio review, positioning and performance attribution. That's available for our contracted advisors. This is Benjamin Levine, Chief Investment Officer for 3D Asset Management, signing off.